Okay, perfect. I think we're ready to get started. As a quick introduction, my name is Tarina and I'm on the venture team here at AngelList. I'm really excited to be kicking off the Winter 2026 Demo Day webinar. During our webinar today, we'll start with a quick overview of what AngelList's Demo Day funds are, and then get into some of the questions that were sent in for our fund leads. Before we get started, I wanted to go over two housekeeping items. First, we'll be recording this webinar and we'll share it with all of you tomorrow through email. We will also be uploading the recording to our AngelList YouTube channel. Second, we'll be spending some time going through some Q&As with the Winter 2026 Demo Day Fund Leads. We had a lot of questions submitted in advance, but please feel free to drop any additional questions in the Q&A function on your Zoom bar. So towards the end of the webinar, we'll try to get to as many questions as we can. Wonderful. Now that we have those logistics out of the way, we can get started. Thank you everyone for joining and showing interest in learning more about our funds for the YC Winter 2026 Demo Day Batch. For those of you who are new to AngelList, we focus on building modern software and pairing that with premium services to help firms ranging from emerging managers to established firms launch new investment vehicles or streamline existing fund operations. And to give a quick introduction on Y Combinator, YC is one of the world's largest startup accelerators. Last year, YC transitioned to a new schedule of 4 batches per year, allowing for more frequent opportunities for founders to participate in YC and present their companies at demo days. Several big companies that you are all probably familiar with have participated in and graduated from the past YC demo days. This includes Stripe, Airbnb, Coinbase, DoorDash, and Instacart, to name a few. So where does AngelList come into the picture? Each quarter, in parallel with YC Demo Days, we have the privilege of supporting 4 esteemed YC alumni who are each launching a fund that gives you the opportunity to invest in the Winter 2026 batch of YC companies. You can choose to allocate your commitment equally across all 4 funds, or you may also choose to invest in specific funds. The fund leads will leverage their YC connections and experience to deploy that capital to what they see as the batch's strongest companies. The purpose of our webinar today is for you to meet and hear directly from our leads. They're all YC alumni, successful founders, and experienced investors. Ben, JJ, Nate, and Philip, thank you so much for taking the time today. We're super excited to have you here and to learn more about each of your investing philosophies and overall thoughts. To get started, I'd love to do a round of introductions so our leads can share a bit about themselves and their demo day investing philosophy. As part of that, I'd love for each of you to touch on why you believe YC is one of the best places to invest in early stage startups, even as caps evolve, and what keeps you excited about doing demo day funds. Ben, we'll start with you, and then we'll go in alphabetical order by first name.
All right. Hello, I'm Benjamin Bryant. So I've been running demo day funds since 2017, backed over 550 YC companies, one of the most prolific investors within inside the YC program. Personally focus on this full time. Very specifically YC investing. Was an early participant in Y Combinator back in 2011. I'm behind one of the angels behind Pebble Smartwatch. Prior to joining the startup world, I spent 6 years as a high frequency trader across 2 fudge funds, and then back in the kind of late 90s, early 2000s, did a fair bit of computer vision research. Have a degree of engineering from University of Michigan, a master's in finance from London Business School. Strategy wise, we really focus on building large, diversified portfolios. Basic thesis is, look, if early stage returns follow a power law distribution, which is essentially saying that, a very small number of your highly, highly successful companies are going to be where you're going to drive all your return from the fund. It's a, optimal strategy to start going broad to increase your probability of netting, more of those, I want to say, exceptional outlier funds. So we really focus on casting a very wide net. Backing, both some of the very hot, the consensus companies that everyone's chasing, as well as, equally making sure we pad out the portfolio with the companies that are, taking, broad, I want to say, deep swings at, kind of risky markets, some that may not be seen, they want to say the most attention at demo day, because really, statistically speaking, your outliers come from anywhere across the board. So that's our focus, and happy to tell you more as we get into the webinar.
Perfect. Thanks so much, Ben. JJ, you can go ahead.
Hey, I'm JJ. This is my ninth demo day fund. So I'm doing this for 3 years now, but I'm a full-time professional investor. I'm also one of the most active YC investors. Founders regularly come up to me at events and they're like, "Oh, I've heard of you," which I guess is not not my normal way of being, but it's pretty helpful when I'm investing into demo day. I started a company in the Winter 15 batch called Way Up. We're the largest marketplace for students and recent grads to find jobs and companies to hire early career. Funnily enough, many YC founders got their first job back in the day, one day or another on Way Up. Ran the company for 7 to 8 years, exited in 2021. When I left, the company was about 150 employees. I then, right after that, was invited to come back to YC, and I worked there as a visiting partner, where I worked with hundreds of companies, helped them collectively raise $200 million in seed funding, and ran the YC program that all of us attended as alumni. I got to be on the other side, which was an incredible experience. Today, I am a full-time investor and run a free go-to-market program for post-seed startups. So that's basically the stage right after companies do YC. And I think with all of that, I'm just very well placed to know how to invest in YC companies. Between having been an alumnus, running a program for afterwards, and then of course having worked there and not just seeing how the sausage was made, but actually making the sausage myself for a bit. So I've been investing for 7+ years now. I have early checks into a lot of excellent companies, both outside of YC and top YC companies, including Ramp, DBT, Retool, Giga AI, Reducto, Gumloop, and others. I've just been, and before all of this, I was in a specialized program at Penn in international studies and business, then worked at McKinsey, then totally flipped and taught myself to code and became a fully fledged software engineer and DevOps engineer before starting my company. So hands-on tech knowledge, business knowledge, seen companies grow to all sizes. To answer the question, YC is just the best, even as caps go up, YC remains the best pool of early stage startups in the world. And I think you're going to hear this from all of us. You get what you pay for. Caps may have gone up and it might look a little expensive compared to other companies sometimes, but when that company is valued at $2 to $3 billion just a few years later, it looks pretty cheap. And you have the best founders, the best signal. And I just feel very lucky that we even have the privilege of being able to dip into this pool, because this isn't something that everybody gets to do. And that's the reason I continue running these funds.
Absolutely. That's super helpful. Thanks, JJ. Nate, you can go ahead and take it away.
Sounds good. My name is Nate Matherson. I think I'm still here. Hey, everyone. My name is Nate Matherson. This is my third AngelList Demo Day fund, and I'm thrilled to be back. I've been investing in YC companies for about 6 years. I've deployed something like $13 million into about 140 YC companies in that time. I tend to focus on SaaS, developer tools, fintech, but I'm not afraid to do just about anything, whether it be data centers in space or curing cancer. I'm open to it within reason. I was a YC founder myself. I spent about 10 years as a founder. I was in the winter 2016 batch and then the summer 21 batch. And these days, in my full-time role, I'm the head of growth at a company called Numeral, which is actually a YC company from winter 23. It's a Series B stage company now. I tend to spend all day, every day trying to acquire more customers, and that's typically where I'm the most helpful with the companies that I invest in. As far as why do I like investing in YC companies, or why do I think it's a good space? Like certainly, like JJ said, there is a premium, but it does kind of feel like fishing in a barrel. It's really like a pre-curated list of wonderful companies, and I think now more than ever, I'm convinced that the most ambitious founders self-select themselves into YC, and so I think it's just an amazing jumping off point to build a concentrated fund at that moment in time, and an ability to get incredible diversity in that moment in time, like nothing you can get anywhere else.
Absolutely. Philip, please go ahead.
Thank you. My name is Philip Winter. This is my seventh batch investing. Been investing in YC companies for about 8 years, 120 investments so far. And past investments outside of YC of note are Anthropic and Perplexity. I co-founded a company called Nebbia. We were making consumer hardware in the summer of 2015 batch. Ran it for 9 years, raised 4 rounds, and sold it in 2022. Our first investor was Tim Cook, and we were also backed by Eric Schmidt and Joe Gebbia. At times, we had more money than we needed. We also ran out of money. We partnered with a public company, and then rebuilt the business and sold it. For the past few years, I've been working mostly as an early stage deep tech investor. And over the past year, I went back to operating at another YC company from the summer of 2018, an industrial biotech company that we sold last year. Did my undergrad at Penn, grad school at Cambridge. I invest alongside two people, Brian Chen, who was in the winter of 15 batch with a company called Blue Smart, and Mike Hinckley, who's a former growth investor and product leader at Airbnb. We do between 20 to 25 companies per batch. As with all of us, our focus is on being early and fast, and it feels like with each successive batch, we need to be earlier and earlier. We sort of clock all this by day, and it's with each batch, it's like a few days earlier that we start doing this. And look at companies at all sort of all ranges and all stages of hype or hotness, and really try and have coverage across sectors. With respect to the question, caps evolving, why we keep doing this, it's a lot of fun. I learn a lot, and the results speak for themselves. So, to cite some stats from Gary Tan and Orange Collective, of funds that build a portfolio of YC companies, which all of us are included in that, the top quarter achieve a TVPI of 8x compared to 1.6 for the rest of venture. And the median, 50 percentile, is still a TVPI of 5x compared to 1.2x. We are fortunate to be fishing in the best pool and have access to the best pool, and that's why we keep doing it.
Thanks, Philip. And thank you all to the fun leads for introducing yourselves. I'd love to dive into some of the pre-submitted questions now. Before we do that, I just want to remind our attendees to use the Q&A button to submit any additional questions that you might have during the webinar. So based off of all of your intros, it sounds like your experience at YC was formative in leading you to where you are now. So to kick us off with the first, I want to start with the founder moments that still show up in how you invest today. So JJ and Philip, let's kick it off with you both. What moment from your time as a YC founder most directly shapes how you invest today?
Am I going first? Okay. So I would say there are a couple of things I look at just thinking back to my time at YC, which was frightening to say, but over a decade ago. I remember hustle and making the most out of YC was one of the things that we did really well that I look for in founders. We looked at, because YC doesn't invest in companies at a great valuation from their perspective. We looked at it as paying, and we wanted to squeeze every drop of value we could out of YC. And it's not the only thing I look for, but it's one of the things I really like to see with how companies and founders are leveraging it. And I think another thing that I pay attention to is I remember from my batch, we had a company that went from the bottom in terms of unofficial rankings straight to the top because they got hot, and then straight back to the bottom right after YC. And compared to some of the more quiet ones in my batch, like Equipment Share, which just IPO'd literally last week. So being a hot or top company bears surprisingly little correlation to who does well in the long run. I would say I learned more from being a partner there and getting to see, founders come in unpolished and come out surprisingly good. And now that fundraising has moved a little earlier, it's helpful to be able to see, okay, which of these founders are not fully polished yet, but in just a few weeks or months or years are going to be, crisp diamonds. So that's what I would say.
To build on that, I would say urgency is the thing that left the biggest impression on me. And the most high impact people that I met, certainly through the program, and then as a result of YC, sort of in years after as an alum, was this sort of propensity towards urgency and rolling up their sleeves. And I think the most emblematic example I have of that was during our interview, which is a notoriously fast-paced interview where you're constantly being interrupted by sometimes as many as 4 or 5 panelists, and they were in person at the time. It's a 10-minute interview. We were making innovative atomizing shower heads. And we brought our prototype, installed it in the shower for the partners to see, after the interview, stick their hand under it, experience the spray. 5 minutes into the interview, and I remember this because there's a stopwatch on the table. Sam Altman, who was, before OpenAI, he was running YC at the time, stood up and said, "Right, I'm going to take a shower." And we didn't even bring a towel. We had like a dirty hand towel, and he said, "Right, I'll take that." Took a 3-minute shower, came out, and then he tried it 3 other times over the course of the summer in his house, sort of different versions, and as did several other partners. And that for us was an example of like, right, I want to see what's going on with this right away. Like, I'm not going to sort of wait and set something up in a few weeks, um, and literally going to roll up his sleeves. And that really left an impression on me. The second example is we had a detailed plan of how we were going to launch, and it was really intense for 4 months. Day one of YC summer batch, two partners said, "Right, why aren't you launching next week?" And we said, "No, no, you don't understand. We got to do all these things. Right, right. Launch, change your conception of what it means to launch, and um, and start building a sense of momentum." And I see that even more intensely now with the newer batches. So those are the things that really left the biggest impression on me.
That's a great story, Philip. And JJ, just building on what you said about companies moving up and down the unofficial rankings, I'd love to hear more about a challenge that you faced as a founder that now makes you show up differently for the companies you back. And I'd love to hear from Ben and Nate on that one.
Cool. Okay, I mean, I don't really think, when we look at what we're seeing up with founders, it's really any specific challenge. I mean, a startup is kind of just a continually gauntlet of challenges. You're constantly trying to get this engine of growth off the ground. But what I think shows up with founders is having been through that, the fact that you've put in the years after years after years to, write something out of nothing. Um, what that kind of, ultimately confers is, look, I mean, experience gives judgment. It gives you a know-how of things, how they actually works, perspective going in. And so, I see founders respond very differently to investors who've actually built something. You know what matters. You're not speaking secondhand about, I heard this growth strategy. It's, no, I've done this growth strategy. That's bullshit there. Here's the things that actually matter coming out of it. And so, I think when it gets down to it is, again, no specific item. It is really that, by having been there, done that, you have this ability to connect with founders at a different level. You confer, a degree of respect. They're looking up to you. They've heard of your product before. Maybe they're a user of that product. And, they trust you. And because there's that mutual trust, that now gives you a really high quality relationship as an investor.
Yeah, that's super fair to hear. Nate, I'd love to hear from you on this topic as well.
Yeah, being a founder is really, really hard. It's often a very lonely place. And I have two answers to this question. The first, though, is I respond to every single investor update that I get, and I just try to be positive and say good things because like founders have a hard go of it. And when I was a founder, there were like typically like 2 to 3 investors that responded. And I know their names. And so at a minimum, like each month when a founder sends an update, I try to show up, I try to be positive, congratulate them on their wins. It sounds simple, but a lot of investors don't do that. More specifically, I think most startups can find one channel in those early days that they can scale for customers. Um, and then they often struggle to find channel two or channel three or channel four. And I think where I can usually get most tactical or helpful with founders is helping them think about like how do we scale beyond that first channel on the growth and go to market side of things. And how do they think about those experiments? Speaking from experience at my first company, I got stuck on one channel and I couldn't escape it. And so now I'm always thinking about how can we build a multi-channel growth engine. And that's typically where I spend the most time with the founders I invest in.
It sounds like creating and nurturing those personal relationships and having that YC background is really important in the YC ecosystem. But just zooming in here, I'd love to talk about how conviction actually forms inside of the YC ecosystem, often before the market sees anything. So, on that point, JJ and Ben, um, for this question, before traction or metrics are obvious, what signals make you lean in on a founder or company?
It is all about the founder. I'll note that even, traction or metrics, even years down the line, might not still be obvious. There are plenty of companies that do well seemingly and then stop doing well. But it's all about the founder, and I think you're going to hear that from everyone here today. And to the point where even the idea that they're working on in the market is only one ingredient in my evaluation of the company, and a surprisingly small one. YC has this saying that, like, you can change the product, you can change the market, you can change you can change the marketing, but you can't change the team. You can't change the founders. So I look for grit, raw intelligence, organizational, being organized, which generally comes in the form of knowing their numbers and market, even if it's a bad market. The fact they've done a lot of research on it to start is usually a really good sign. Because, by the way, maybe they know something I don't, right? Like, every startup that is successful is definitionally exceptional. So, like every Airbnb of the world started out as something that everybody thought was crazy and couldn't possibly work, and then it did. And then, I look for energy and hunger. Those are all the things that are going to take a company from some small little thing to something worth billions and billions of dollars. And having talked to thousands of founders at this point, you kind of begin to see a pattern of the different archetypes of founder. So I take all that. I also do a lot of background research myself for the batch that I'm deep into right now. And then I get a lot of insider information from, people who know the founders and from inside YC as much as I can to get sort of a head start on, who seems to be working really well, regardless of the traction or the market they're in.
Yeah, that's a great point about the background and the experience of the people that you're working with. Ben, I'd love to hear from you on this one.
Cool. Yeah. So, I mean, it's definitely not a checklist. We're looking at every company is different, every founder is different, every market they're currently working on is different. I mean, these, inherently are not commodities. Um, so I think, outside of just a baseline set of things that everyone's looking for, it's really looking about how the pieces of that fit together. How do the founders talk about it? How do they think about what they're currently up to? It's getting a sense of how they think through the process that that, I mean, these are essentially explorers that are going on an adventure that are going to have to constantly iterate, constantly change, constantly improve what they do. So, you know, our process starts off with, a lot of research. We're pulling in every piece of information, every little tidbit of, intel that we can get about any particular companies and, really building our target portfolio, which we typically hit around 50 companies each batch. And, at that stage, we're trying to optimize, the portfolio. And then, a lot of the decision making comes into a half an hour call. With the founders, and you get a sense to see the pitch. So it's typically about 10 minutes of the call is getting their pitch. That's kind of checking up against what knowing, coming up with things that are what to say might have not been apparent in the imperfect information you are presented with a priori. And then it's really talking through the different deals, and it's not so much that you're looking for any particular thing. You're looking for a nature of how they respond. So are these dynamic individuals that articulate and think in the way that a founder should think? And that can be different from different people. Do they have perspective on what they're up to? Are they willing to be open about what are the problems that they're facing today? And can you work with them and see a pathway to take where they're at today and move it to a better place tomorrow? And if that's the case, then that gives you a really strong kind of indication that, hey, no matter what happens across the basically 8 years that this company's journey is going on, that to the best of their ability and kind of the best of what one expect, they're going to be able to adapt to it. I mean, we're very fortunate in the YC space. The bar is almost, I mean, it is exceptionally, exceptionally high. So it's very rare that we actually, at that stage come across a founder who's not the right fit. But, that is the kind of, impetus and so forth. Like, we are among the first, if not among, the actual first call that these founders are taking. And so, it's certainly well before anyone is drawing conviction, but we play a visceral role in basically helping establish that conviction with the wider market. And, I think if we look across with everyone on this board, like, we're all in that boat. We are part of the engine that, helps lift these companies up into the spotlight and so forth. And that, in essence, helps our portfolio.
Absolutely. And just building on that conviction piece, I'd love to hear about a time when the conviction showed up before the rest of the market agreed and what you were reacting to. So I think here we can have Nate and Philip jump in for this question.
Yeah, and Ben, I loved your answer, by the way. I want to answer this question first with a statement. I think everyone here will agree that we cannot wait until like the market has decided this is a good business. I think now more than ever in a YC fundraising season, you need to move quickly. You need to build conviction quickly. And I think all of us here do a great job of being at the very front of the line. I think given that we've all been investing for a number of years, we have positive ratings in the YC investor database. We've got good reputations that allows us to be the first, if not of the first calls that founders will take into their fundraise. I think that's really important for us in terms of being able to get allocation in deals, being able to get allocation at the right prices. But to answer your question directly, I'll echo what JJ said. It really does all come down to the founders. I think to Ben's point, I think as we get on calls, we try to validate a lot of the thinking we've done. But it comes down to that conversation with the founder. And having been on 1,000 of these pitch meetings over the last 6 years, typically within about 10 minutes, I feel like I have a good feeling or not as to how the conversation is going.
To answer the question, a time when conviction showed up before the rest of the market agreed, as it relates to our, little sort of micro world of YC investing every batch, which is a very intense period of a few weeks leading up to demo day. We are not thinking about the market and what the investment market thinks about this company. If we if we if we hesitate for a moment, the opportunity is gone. Um, and so that goes back to what's been said already, which is it's all about a high uh, conviction and um, strong impression of the founder. Um, Having said that, there are certain markets that we think are very interesting. And YC already sort of gives an advance on that with their RFQs and their, requests for startups, um, which they've just put out. And it's very interesting. This is one of the batches where I've noticed sort of the most difference. Um, as an example, a year ago, um, we backed a very impressive team doing AI shopping assistance for thrifters. Um, the space, interesting, founders, fantastic. 2 months later, they pivoted to a consumer app for helping couples grow in their sort of romantic relationships. And it's now one of our fastest growing companies. You could say that we saw an opportunity in consumer apps, but the reality is it was all about the caliber of the founders that stood out. And like that, there are any number of examples in all of our portfolios.
Yeah.
Those
Well,
founders are killer, Philip, by the way. I know which ones you're referring to. Sorry, I didn't mean to interrupt you, Tarina.
not at all, Nate. Philip, I love what you mentioned about not being able to hesitate for a moment, right? So sort of drawing on that thread a bit, I'd love to hear about an opportunity where you've passed on a company early that later made you actually rethink your framework, and what changed when you framework without giving any names. I think we can hear from Ben and Philip on this one.
Yeah. Um, you know, for me, let's see, passing on companies is more a kind of function of capital constraints. Conceivably, like, there's kind of a minimum check size we need to write to play the game, and we raise a certain amount each fund. Um, So for me, if, I could do 30% more companies, I certainly would. My model and viewpoint is there's kind of a bar that you need to cross, and the act of, investment and making decisions is much more, a filtering. Where it comes down to companies that, we've missed, it's often that they just didn't show up on their radar. There's always a small section of companies that is just, out there, or they moved and closed around, even pre, say, webinar call here, when, we weren't really in a position to, you know, commit or act. I think the, thing one needs to understand about demo day is it is not a scenario where you get to look at everything, dive into it deeply and make your decisions. It's a 3 weeks period where, for us, we have capital coming in, we have capital going out. So we're kind of forecasting, what our kind of allocation strategy needs to be during that period. We have companies that are coming on the markets in waves and coming off the waves. So you have to act on your first batch of companies before you're going to see the next two batches or so forth, that comes off. And then you're acting on very imperfect information. I mean, just aside from, you know, kind of the limited amount of information we have, it is early stage investment. We are trying to forecast 8 years out. Like that's just not realistic in this particular scenario. There's so much exogenous activity that comes up or things that change as, sorry, not Nate's, Philip's reference here to the company, which we also batched as well. It's like, the pivots come out of nowhere, but it's because someone went on a journey and found something unique that no one else seen. It's the act of searching that gets you to those like truly original ideas. And there are some companies that they come in right from day one. They've hit on something, they have tremendously good traction, and they just keep going up. I call it the version of the queen of the company. It's like we started a rock band and we just were successful. End of story. Like you have those as well. But it is this very, very dynamic situation. And so, what I think about when it comes to the framework is like, we very intentionally have designed a framework that is structured to capture and work for this. It is a stochastic process, not a deterministic process, and therefore focusing on risk management, focusing on exposure, maximizing our expected return from our perspective is where the optimal, strategies there. And that allows us to, work dynamically. And instead of kind of running away from risky situations and trying to, set ourselves on, things that we can kind of feel sure about, it really is let's accommodate that risk, let's accommodate the uncertainty and plan for it. So that's my view.
Just an interesting sort of tangent I think is important for everybody listening. The four of us have very different strategies. I mean, our portfolios will probably range from 10 companies to 50 companies in the case of Ben. And I think that informs, how we come across these situations, And so in particular, a company, what I learned from a company that I passed on that I wish I hadn't passed on, it was about 8 months ago. Um, you've heard us say a large part of the game that we're playing is about access and speed, time to market. Um, Unfortunately, my batting average is not 1,000 on this. There was a company in the spring batch of last year that I loved, but hesitated on, and I missed them by a day. And I have enjoyed watching them take off, painfully from the sidelines. I wasn't convinced about the idea. It was sort of very personalized agents for whatever task. It just felt way too broad. But the founder was magnetic. There was a thoughtful relentlessness to what he was doing, and he had urgency, which I mentioned earlier. And I should have decided on that alone, given how standout he was in that core criteria. Um, and that has left a very significant impression on me, especially as I see his updates on LinkedIn. And fortunately, we've stayed in touch. But that was one that sticks with me.
It sounds like it always comes back to the founder, really, and sort of their approach in running the company. But I want to talk a little bit more on the investment strategy. And Philip, you mentioned that that's different across the leads here. So, JJ and Nate, I'd love to hear more about how you tell the difference between information that should change your investment decision and strategy and information that you should ignore.
Yeah, this is a bit of a tough question when we're talking about demo day to as Ben and the others mentioned, it's not like a single day. Things are moving very, very quickly. Very often, I would say most of the time we're deciding on the call and offering on the call. So pretty much all of the information that we're evaluating here is stuff that we either we learned ahead of time through research and asking around, or picked up just from the one call. But with enough practice, I think this becomes fairly clear. I think of this in a few different buckets. One is anything that would impact a founder's ability to do well. I mean, maybe this is obvious, but there's some things that impact a founder's ability to execute well. And these are pretty basic things like ability to be organized, communicate well, think clearly, organize their thoughts. There are many different types of founders who come off very differently, but a founder who is incapable of explaining the basics of what they do most of the time are unlikely to succeed, even if it's something complex. There are a lot of other things that can be heuristics for if a founder is good or not, and those are things you have to be really careful with. Where it's not even things that in regular society might seem to be negative. For example, a founder being rude or prickly. For some founders, it just means they're not nice and actually going to make lots of enemies and not do well. But for other founders, it just means they're very strongly independent, don't care what you say, and they're correct and going to build a huge company. So you have to really, really be very careful with those. And I think largely I come back down to it's not a checklist like Ben says, but you sort of get, you even heard Philip just say now, magnetic. Like as much as it might feel a little silly on the other side of these webinars, you get this feeling from meeting with the founder and you do it enough times, you begin to learn to listen to this feeling because the feeling is actually much better at the early stage for being able to tell if a founder is going to succeed than a lot of analysis you could do of their traction at this point.
Yeah, that feeling is maybe why I do it. It's certainly something that's hard to describe. I think we all here have had so many conversations that, after doing 50 meetings in a row, like if you do a meeting and you have that feeling, like you should definitely act on it. That's how I think. But as far as like what information I would change my decision on, well, I think like these founders are often first time founders. They're mostly first time founders. Increasingly, they are young founders. So I don't think like the pitch needs to be totally perfect. One of the best performing companies I invested in to date, like the founder took the call from like a dark basement. It was like super sketchy and like did not seem right, but like it's the best performing company in my portfolio in that fund. So I don't think the pitch needs to be perfect. But what I index really heavily on is if I ever feel like I'm being misled. If I ever in any way feel at all a sense of dishonesty, maybe even if it's unintentional by the founder, or if I feel like I'm being misled around traction or revenue or a customer, that's a pretty hard no-go for me. So even if everything checks out, but I walk away feeling a little bit uneasy about what was said, I won't do it.
Yeah, that's super fair. Thanks, Nate. So I want to talk a little bit more about how thinking evolves when sort of the facts on the grounds change, specifically in that example where you're being misled, but also as it relates to certain industries that you all have been zooming in on. So, Philip and Nate, starting with both of you, could you tell us about a sector, thesis, or belief that you've meaningfully changed your mind on since you started investing? And what caused that shift in belief?
Sure. I would say hardware and robotics. And perhaps this is a bit of a contrarian view given the increasing hype around robotics, particularly AI applied to robotics. Um, but fundamentally, robotics companies will have the unit economics of hardware companies. Uh, Generally, there will always be outliers, but they are businesses that will inherently struggle with things like gross margins, supply constraints, manufacturing, transport timelines. The physical world has certain limits, and these things make it very hard to scale at the exponential rates that venture investing requires. And as I said, there will be outliers, um, but the bar for dominating in that type of space, I think, has to be much, much higher than with software companies. And I've made several robotics investments, um, but my bar is much higher for industry experience and a sort of broad understanding of what goes into making the different aspects of the business successful. Not just a technologist, not just someone who has a great vision around product or the market in some case, but has to understand how they're going to finance the different stages. Um, Having said that, when coming across them, it's really exciting and it's an enormous market.
I had two answers here on the thesis and sector. The first would be like when I first started investing in YC companies 6 years ago, I used to index very heavily on traction. Let's say, for example, revenue traction, which is ultimately those companies ended up becoming some of the most boring companies in my portfolio. And so at this point, I index less on traction at the date of the conversation. Say they're 2 months into building their company. I think that moment in time, like maybe traction, whether it be revenue or something else, isn't actually the best indicator of long-term success for the business. But as far as like sectors go, like I've historically invested in a lot of software. But one thing that I'm really excited about these days is instead of companies selling software, they're focused on selling like the solution or that end outcome. And I'm really excited about the businesses that are not selling software, but selling almost like a tech enabled service or solution with software that really just delivers the customer the end result that they would have been trying to get to if they had bought software. So that's something I'm thinking a lot about these days, especially as I think about doing new software investments.
Thanks, Nate. Double clicking on the piece about over indexing on revenue traction. Ben and JJ, I'd love to hear more about how you decide whether an investment thesis or an investment metric that you're really following is still on track or needs to be rethought.
Um, I mean, if I look at our approach, fundamentally, we've, designed and built a thesis around managing risk and uncertainty. So, as we go through, the fact that markets are going to ebb and flow and change over time, is kind of planned for and anticipated. What will happen is some companies will go a direction, fall off, peter out, change around. Other companies will just that have been before will have caught that wave right and suddenly take off, or they'll, discover a new wave to capture. I do think there's a lot of, particularly if we look in like the AI space right now, there is a lot of problems that are problems today and kind of assumed problems in the future. And you're always playing around in the space trying to, figure ones who are doing really exceptional at solving the problems today that kind of saw that a little before, and those that are kind of, anticipating where the puck is going, so to speak. And sometimes you're right on that, sometimes you're wrong on that. But, what inevitably happens, I've looked at this, if you go back to crypto, if you go back to other areas, it's like the companies that are playing in a space today, even if they've not figured it out today, they are the companies that are best positioned to capture the unexpected within inside that space. You cannot see, oh, there's, a memory problem with AI and we need to control this. If I jumped in that today, I am well behind the curve of everyone else that has actively experienced that problem for the past 6 months or year and so forth. And so, when it comes down to, thesis and so forth, I think, there is, you're building a mix, but, it's a lot of you're trying to look at people who are deeply enmeshed in a problem space in a market, are working on interesting things, are constantly exploring so that you're going to increase the probability that they're going to hit up on something that really is, meaningful. And then you flip over to, what you call deep tech or so forth companies where generally, let's say fusion power in space or so forth, fusion power in general, it's like if we crack that nut, the value of that market is massive, but you have huge technical risk that's associated with it. And so you're looking at, well, what are those want to say differentiators that say, this idea is not just doing fusion, we've moved up into space. And because that we don't have the intrinsically big problem, which is how do you contain this, molten plasma? and so forth. And so you can say, oh, that's a materially different thing. Where data centers, the space that, Nate had mentioned, it's like, all right, at scale, they really have a large material aspect. Same things happens with, data, various AI problems, various kind of back office solutions. So, that's a lot of how I think about, this working with inside these uncertain situations.
I would say my investment thesis, this is maybe a little tautological, but my investment thesis is at early stage, the best founders are what matter. And then YC already has the best crop of best founders. And if you pick the best of the best, you're going to do really well. So it's not, I am supporting founders all the way through their journey. But it's not to say that I'm sitting there and have an idea about a thesis of, yes, I'm very convicted that this market is going to do extremely well or not. I have ideas and thoughts and opinions, and I try to share them with founders if I think it's relevant. But at the end of the day, like the founder has to be the expert. They should, I mean, hopefully they know more than I do. If not, it's a problem. And really, what I'm looking for are amazing founders. And then, even if it's a market that I think or something is super risky, to Ben's point, asymmetric upside. So, sure, we could talk about data centers in space, or we could talk about building the first supersonic jet, and they're extremely hard and probably won't work. But most companies probably don't work. But if it does work, it will literally change the world. So that's a lot about what we're looking for. And I think to really hammer home the point on founders and why I'm so founder focused, even some of the ideas that you think would be the most specific and unchangeable many years down the line, Boom, the supersonic jet company, which was before my time as an investor, is one of my favorite examples where he's been building supersonic jets for many years. He started with absolutely no prior aeronautics experience in terms of like building a plane. He just did YC. And many years later, this past year, he announced that Boom is now going to also start powering AI data centers with energy from some of the other stuff they've built. It's not a pivot. It's part of what they're doing as part of their company. But it was not obvious. I never would have expected something like that to happen. It's going to help fund the business. And all of that happened because the founder has the tenacity and strength and wisdom to see this opportunity and take advantage of it. It has nothing to do with just like the market that they're in or something like that. So I guess to really make this more concise, the thing that would make me reconsider an investment thesis is if I see the founder turning out to actually not work that hard, be limp, not have grit, kind of doubt themselves.
Yeah, JJ, that's interesting, especially seeing how that changes over time. Philip and Ben, I'd love to hear a little bit more about the parts of a company's early positioning that tends to compound the most over time. So beyond the founder journey, what parts of a company's early positioning tend to compound the most over time, even if they're hard to measure early on?
Yeah, I thought this was a really good question when I was preparing. And there are probably lots of aspects, but the one that I find myself most often coming back to with founders after we've gotten through the pitch stage and sort of checked out the basics is how thoughtful are they when it comes to distribution? And here there's a huge spectrum with YC founders. Um, yeah, I'm looking for things like, do they have a nuanced hypothesis around who their customer might be? If they're at the stage yet where they haven't figured out who the core customer likely is, which is fine, but what is the thought process? How thoughtful are they behind it? Are they literally just building for themselves, which is fine, but is there a reason for doing that? Um, have they thought about customer acquisition strategies? Have they failed at certain strategies? What did they learn? Most important question. What did they learn from those failures? And in turn, what did they change to try the next time? And it's fine to say that it's going to be all product-led growth. Um, uh, but even that as a strategy has some key underpinning activities and costs that can, exponentialize it. Those are the types of things I'm looking for. And then two other ones sort of that I think are worth mentioning are judgment and taste. Um, what customers do they say no to? And how quickly are they to arrive at that? Do they chase obvious things or are they focused on a long-term strategy and there's sort of a logic of what their next moves are going to be? Those are the things that I think really stand out and if done well, um, really lead to the exponential curve that we're all looking for.
I mean, on my end, I think it really comes down to the, I mean, just how the founders approach the problem? What is the driving force behind this business or the people that are pushing to make it success? And I mean, there is just kind of, unmeasurable quantities, tenacity, conviction, things around there. These are, nuanced in how they go. And then it's looking at that in relationship to, the company or market that they're facing. How do they think about it? How do they talk about it? And, there is just, you know, there is a difference between someone that just can kind of systematically break down and focus on what is important to them today and execute on that. And, we're not seeing that in a forward-looking session, but we have the luxury of, about 10 weeks of YC performance where we can say, all right, what did they accomplish over the batch? How did they accomplish it? Even if they pivoted, a week ago prior to us talking to it, you can see and understand what led up to that pivot and what led to that decision. They can say, like, look, this market just was not going to work for us. And so, we've moved to this different direction. And so, it's that adaptability. It's these, you know, soft-ish skills and kind of, introspection that I think, ultimately leads to someone being able to, set the best strategy, execute on that strategy, pivot and change, and ensure you're maximizing the growth of this business going forward, heading into uncertain circumstances.
Yeah, thanks so much for that answer, Beth. JJ and Nate, I'd love to give you both an opportunity to speak to this as well. So beyond sort of picking the right companies or founders, where do you think those long-term returns are really won or lost at the earliest stage? And I recognize that's a huge question, but appreciate your thoughts on that one.
Yeah, well, I think I don't know what Nate's going to say here. Hopefully, it doesn't say the opposite of me. I think actually the only thing that matters in venture is picking the right companies. Now, that being said, you can have many companies, right is sort of ill-defined, where you could have great founder and a great company, and it turns out the market doesn't support it, but nobody knew that yet. But venture is inherently a power law game. All that matters is being in the right companies. So, the way all of us structure, I can only talk to myself, but the way all of us structure our funds in one form or another is to maximize our chances of having a good amount of money or as much money as possible in the right ones. For me, I try to find the best founders in the batch, and then invest in, the top X, like 15-20% of the best, but you need to be in the right ones, which is why I go wide enough that you have a lot of shots on goal. So I think the question is actually not what matters beyond the right companies, but what strategy do you have to make sure that you're in the right ones? Where right ends up being defined as, we're talking 7 to 15-year journeys here. Lots of things that may seem obvious today or wrong today can easily change 5 to 10 years from now. And all of a sudden, companies that were not winners become huge winners. One company from my batch went along with basically just no extra funding and ramen profitable, meaning they were barely profitable for 7 years. And then over a month went from barely any revenue to $1 billion valuation 7 years later. This kind of stuff can happen. So for me, again, I come back to using my experience, research, and insert information I can get to pick enough of the top founders in the batch that we get many shots on goal. We can allow for mistakes or things that are unexpected, and then that we can also allow for just the randomness that comes from having to wait a decade to find out how everything is going to do.
I think I disagree with you, JJ. I wanted to find something to disagree with because you kind of put me on the spot there. But no, I think that was a great answer. I think picking the right companies is important. I mean, I think you also want to, at those earliest stages, pick the right founders to go with those companies. There are good ideas, but you need the founders to go with it. I think maybe a little bit of nuance here. I think we can all pick companies, but another part of it is actually getting in those rounds or being in those rounds. And so there is this component of picking, getting in the round, and then to your point on how do we maximize long-term returns, it's also getting in the round at the best price. There was an example in this last batch where I was the first check into the company, and then 2 days later, they were raising at a valuation 100% higher, right? So like there is that dynamic in YC. It happens all of the time. We've all invested in deals like that. And so not only do we need to pick the right companies, but we need to get in those companies, and we need to get in them at the best prices to maximize long-term returns for the LPs of these funds.
Yeah, that's a great point, Nate. Ben and Philip, one last question here. So we keep hearing about magnetism as being a key founder trait to look out for, but outside of that, what's another behavior or mindset that you've seen consistently separate founders or investors who outperform over time? And we can start with you, Ben. Oh, Ben, you are muted.
Thank you. I think these are two, very different disciplines. In a founder, you are going to pilot a ship across an unknown ocean and, conquer whatever may come along. And so, the best founders are myopic in their approach to whatever it is they're up to today. I mean, just obsessed with growth, obsessed with outcomes. I mean, I think if I look at some of our, best, fastest portfolio going companies, the ones that have really come up with the difference, like these people come off as unusual individuals. And, I mean, there's times when, we have backed companies where it's just, you feel, you know, borderline, this is could be complete fraud coming up here. And, at the same time, they just approach the exercise of building a business, from such a different perspective. I mean, like, I mean, I've had people that are like, well, I want to get, this lead, I mean, specifically Andreessen Horowitz on the table. Well, I'm going to go talk to Mark Andreessen, knock on his door and invite myself to breakfast. And they just go and do it. And it's like, that's not normal human behavior. But this is Silicon Valley. Like those individuals exist here today. They're attracted to YC because of the brand of YC, and a percentage of the individuals that, show up on our radar, are that. And, next thing we see they're, just through the roof in terms of growth, in under a year. And then there's a lot of, mid-tier founders that do exceptionally well and discover stuff every year. That's not a criteria for success, but it is what you see in the best founders. I think on the investor side, it is like, investment is a business. And it's, those individuals who approaches a procedure, like systematize what it is they're up to. I mean, finance is not a novel discipline. It's a discipline of risk management, optimizing your returns. I mean, you can look at it in public markets to, startups. And I think, it's interesting, startups early stage has really become a very mature market over time. A lot of the dynamics of, pricing pressure. I mean, like Nate alluded, price discovery. Like we are in a very unique period where these companies are coming on the market and no one knows exactly where the market's going to value of it. The wonderful thing about working with alumni investors like us and other ones that participate in the project is they're the people that are going to talk first. You come in, often get kind of preferable valuations, and then the market corrects yourself or incentivized to help, push that. So, that really comes down to, I want to say being able to kind of, get access at scale, having the relationships, the discipline to move through this, just immersing yourself in this particular, want to say unique marketplace. And those people that come and do this repeatedly, every batch, in and out, much the same that YC rises amongst the founders, we rise amongst the YC founders. And, it becomes a difference between, early on having to seek access to these companies, knock on the door, sell yourself to now, we are the individuals that kick off rounds. We are the individuals that make, green light stuff into this ecosystem and become the individuals that companies themselves seek out. And I think that really changes, improves the dynamics. Like, the investor game is a very long game. It's about reputation. It's about access. It's about planning for and working for the future, not short-term gains. And I think that's what, in that regards really differentiates those who truly succeed in this ecosystem versus those that are kind of more tourists.
In terms of a behavior mindset, that I think consistently separates founders, I would say two things. The first is honesty, and the second is consistency in reporting and updates. As for the first one, honesty, do they tell the good and the bad? What do they learn from it? At some stage, the flip switches at the very, sort of even in the early stages of building a business. So it could be within the first year after YC, um, where you're only thinking about customers and product, to also having to worry about things like team culture, operational efficiency, operational excellence, financial planning and analysis, and all of the other things that come with running a business. Is the founder honest with themselves about what aspects they like doing and are well suited to be the best person doing them for the business? And in the areas where they are not, are they capable of delegating those so that they are done to a certain standard to continue to push the business forward? Um, and then consistency in reporting and updates. It's remarkable how often the updates fall off, even a few months after the batch. And the best companies show up in the inbox same day of every month. Um, and you can see sort of the transformation happening in that individual and in the company over the arc of those. And having written those updates every month, it's really painful when your growth is flat or negative for a few months in a row. But are they doing that? Do they keep showing up? Do they keep doing that? I mean, you will inevitably go through that period, but you have to get through it and not just kind of give up and feel sorry. And that for me is one of the most telling signs.
Thanks, Philip and Ben, for those insights, and thank you, JJ and Nate, as well, for sharing your backgrounds and insights into your investing approach. We are at time. Thank you, everyone, for staying a little bit over time. You can find additional information about each of the Demo Day offerings on the fund pages, documents, and on our Demo Day website, which will drop in the chat. Just a quick overview here. The minimum to invest per fund is $5,000 with an expected closing date of March 16th for all funds. So investments will be accepted until the close date or until the funds reach capacity. Thank you again to everyone who tuned in today. And if you submitted a question we couldn't get to, please send it to demoday@angellist.com and our team will follow up with you directly. Thanks again, everyone. Have a great rest of your day.
Thanks.
Thanks, everyone.